Ryan Bolton here, local mortgage expert. I often get asked the question, how much income do I need to afford a particular home? So I wanted to run down some numbers and how we calculate the debt ratio, just so you get an idea how these numbers might play out for you. Now, I'm going to just use examples. So there could be different loan amounts, taxation rates, all those types of things. I'm in southern Utah, Washington County, Utah. So I'm going to use numbers that are very similar to this particular area. So let's start off with the sales price. So I'm going to put 450,000 for the sales price. Let's do 10% down or 45,000. So that would be a loan amount of 405. Okay. Now I'm going to use a 6% interest rate. That doesn't mean that's what rates are today, of course. They can change daily, and it depends on credit, a lot of different factors that determine an interest rate. So this isn't the actual rate of the day, but I just want to at least show you how the numbers pencil out. So if we do a 30-year fixed rate mortgage at 6%, I wrote down the payment for this would be $2,428.18. So that is the principal and interest on the loan itself. Now, what gets added on top of that is things like the property taxes, the homeowner's insurance, and possible mortgage insurance. And we'll go over that here in a second. You would also have to add any kind of HOA, which is a homeowners association. So if you're buying into a subdivision that has common areas or pools, tennis courts, things of that nature, that's a fee that gets added on top of there. So for this scenario, let's go over the homeowner's insurance. Homeowner's insurance covers fire, theft. You can add earthquake. You can add other things, but just basically the coverage on the building itself, that if anything were to happen, it would get rebuilt. So home worth about 450 can vary if there's a pool, or it can vary square footage and year built, a lot of different factors. But just for the sake of the argument, let's go ahead and put $900 a year for the hazard. So let's go with 900 a year. And then in Utah, the property taxes are due every November. So typically what you see is a lot of escrow accounts in Utah to make sure that you don't have one big lump payment every November right before the holidays, but you have 12 easy payments just added to the loan. So home worth about 450,000. I would estimate about 1,900 in property taxes here in Utah, but it also depends on if it's a primary residence, a second home, investment property. But again, just for the sake of argument, we'll just put the taxes at 1,900 a year. So if you divide those out by 12, so I'll get my fancy dancy calculator here. We'll add 900 plus 1,900 is 2,800 a year divided by 12. Let's go up here. That equals $233, and let's just round up the pennies, 34 cents. Okay, so now let's add all of those together. You've got the payment on the principal and interest, the hazard insurance, and the taxes. Let's add all those together. So 24, 28, 18. So you are a grand total of $2,661.52. I'll call it 52 cents. Plus 24, 28, 18. Okay. So now, because you put 10% down, as you can see here, you have to add either monthly mortgage insurance, or you can pay a one-time fee to buy it out. Let me show you how that works. Many people don't realize this is an option. So here's one of our mortgage insurance providers. We have a lot of them that we work with. I just really like ARC. They're one of the better ones out there. So I go up here and get a quote. Let's throw in that scenario. Let's put in the zip code, that base loan amount. The loan to value is 90%. Now let's leave all these the same. So this is a purchase, a fixed rate, not a buy down, 30-year term, all these fun things. Let's add two borrowers. Let's say their credit scores are 740 or better. So I'll just put 741, again, just for the sake of the argument. Primary residence, let's say the housing expense equates to 20% of their income, and their total debt ratio is at 40%. Again, just to calculate a number. So you can see any of these things in these fields can change what that mortgage insurance is, but this gives you a rough idea what the mortgage insurance would be. So you can see here's the monthly. So this is what it would be each month. Or you can pay this amount and buy it out completely so you have no mortgage insurance for the life of the loan. It's just prepaid. You can also do a hybrid. These guys offer where you can pay a small upfront fee and then the monthly is lowered as well. So you kind of do a bridge between these two. So what I always like to do is take the buyout amount divided by the payment and see where the break-even point is. In this calculation, it's just over 4 years. So if you're planning on keeping the home indefinitely, have no plans to move, upgrade, downgrade, kids are going to school for a long enough period of time, or retiring here, something like that, the single pay is a great option. Buys out the mortgage insurance for the life of the loan, regardless of what it's worth, regardless of what happens to the value of the home, all those things. If it's less than 4 years, you might be better off just paying this amount, because here you would have prepaid too much of it. So that is a factor. So just for the sake of argument, let's just do the monthly MI. So let's add plus MI of $70.88. So now we have another grand total, 26,152 plus 70.88. So grand total is $2,732.40. And again, that can fluctuate with the rate, that can fluctuate with the taxes, insurance, mortgage insurance. You can see how these numbers can really change based on everybody's specific situation. So just keep that in mind. But I wanted to run those numbers. So that's the mortgage payment. So that's what we have to first calculate. Next thing, we have to add any other debts that are on credit. So let's say there's a $500 car payment. So go $500 for a car. Let's say there's a couple credit cards. Let's say the minimum payment adds up to $100. Again, just for the illustration. So we got 100 in Visa. Let's say there's student loans. Now, this is a tricky one because a lot of people will say, well, they've been deferred. There is no payment on those loans. Well, lenders know that eventually a payment should be due on that debt. So they can't just completely ignore it, but they don't know exactly what it's going to be. So they've come up with different guidelines, and they are changing and fluctuating. The most common one right now is 1% of the balance, or a letter from the company saying that if it was out of deferment, what the payment would be. So I'm just going to put $100 in there just again for the sake of the argument. So we'll go 100 for student loans. Student loan. Just again, so we have a number that's in there. So now let's add all those up. 27, 32, 40, $500 for the car, 100 for the Visa, 100 for the student loan. So now we are at a total of $3,432.40. So that is the debts that are on the credit. So then most of the loans are going to be a 45% ratio on that number. Now I've seen it higher or lower depending on credit score, loan to value, time on the job. There's a lot of factors, just like you saw with the mortgage insurance. There can be a bunch of those different factors that are on there. So it is something where everything's going to be a little bit different based on your individual situation, but it is something where 45% is generally a number that we use. So that means to qualify for that amount of debt, so we divide that by 45%, we have to make $7,627 and I'll round it up again, 56 cents. So let's times that by 12. That is about 92,000 a year. So 91,530 is what you'd have to make per year. Now that's household income. If there's two borrowers, just like we did up on the mortgage insurance, we put two borrowers on there. So that gives you a rough idea. Now, some of the things we can change or help with that, again, we can get rid of the mortgage insurance. So you got the mortgage insurance, you could prepay, that helps lower that, which would lower these numbers. You can put less money down and use that to maybe pay off the visas, pay off the car. Student loans are going to be tricky just because who knows what the rates are going to be. Those are most, and usually the $100 payment is way cheaper than getting rid of the debt. But usually a $500 car payment, we can get rid of that instead of putting the extra money down. So this is part of my job, is to review all the ways we can maximize the income while maximizing the budget and help people into better loans. This is really one of the better ways. Get rid of that mortgage insurance. $70 a month can go a long way on a mortgage. So that's just some of the numbers I wanted to run for you to be able to show you how much income you'd have to earn to qualify for this scenario. Now, if you have a scenario you'd like me to run, it's very easy for me to do those numbers. There's no cost or obligation. If you'd like to get pre-approved for a mortgage loan, check out my website at ryanbolton.com, and we can review all these numbers, plug them all in for you, find out what you actually qualify for. So you're not out looking at homes you either can't qualify for, or if there's some ways we can get you into that next bracket, that can make a big difference. I mean, if you're in the $250,000, $300,000 price range, and just a little bit of tweaks here and there can get you into the next tier, you're going to find a little bit more square footage or garage or location. Just a lot of things can be changed by increasing that value. So Hopefully you found this entertaining and enjoyable, and hopefully that breaks down some of the numbers for you. Please leave a comment, subscribe, ask me any other questions you'd like me to do a video on. But I appreciate your time, and I really do love what I do for a living, and I'd love to help you with a home loan. So check out ryanbolton.com, and I hope you have a wonderful day.